In this video, we're going to be going over Chapter 5, looking at the idea of consumer credit. One of the areas where a lot of people get themselves in trouble is with credit. And so what we want to do is make sure that people are aware of what it is that they can do and how they can handle some of their credit. You can see the learning objectives for the chapter, okay, the advantages and disadvantages, types and sources, figuring out, can you afford to borrow the money that you're looking for, what kind of cost is involved in the credit, and then also think about how to protect your credit and manage your debts. Now, credit is basically where you are getting a loan somewhere, okay? So in other words, you are wanting to buy something, and so you may be doing it on credit. Now, it's been a huge force as far as the economy is concerned. It's one of the things that's really helped to grow the economy. The thing is, before you use it, really think about it and think twice, okay, or even 3 times. Do you have the cash for the down payment? All right, are you going to use savings to use it instead? I mean, would that be better for you? Does it fit your budget? Could you use that credit in a better way? Could you postpone it? Do you have to have it right now? Things like this. Now, there are a lot of advantages to credit. All right, you can get stuff now, all right, that you might need. In other words, maybe the washing machine pooped out or something along those lines. It helps you buy something when your funds are low at some point in time. It's easier to return stuff. If you order something off of Amazon, it's much easier to return it if you've put it on a credit card. And so there's a lot of advantages that go along with credit. It's safer than carrying cash, all right? You can be jumped and have the cash taken from you. If you are going to travel, you will need to have a credit card. So in other words, if you're going to get hotel reservations, or you're going to rent a car, or you're going to get an airline ticket, you have to have a credit card to do that. Now, some of the disadvantages. Man, a lot of people will overspend when it comes to their credit cards. That's one of the places where people really get themselves in a world of hurt. It ties up the future income because you're having to pay that off, and it costs money. A lot of credit cards are carrying very high interest rates, and again, borrowing money costs you money. Now, there's 2 different types of consumer credit. You have closed-end and open-ended. Closed-end is where you're getting a loan for a specific thing. Open-ended is using it when you need it. So, for example, closed-ended, you're buying a car and you get yourself a car loan. What happens is, over a series of years, you're making consistent payments and paying it off. You can see how consumer credit has grown over the years. It's amazing how much it has grown, and it has really helped the economy grow. The thing is, it needs to be paid off at some point in time. When you start thinking about open-ended credit, that's like a credit card, all right? And what happens is it will give you a limit, okay? It may be, $3,000 or $10,000 or whatever it is as far as a limit is concerned. And as long as you put things on the card and then you pay it off. You have a zero balance, you can put some more things on the card, that sort of thing. What's interesting is the average credit card holder has more than 9 credit cards. And a lot of times those people have a tendency to be borrowers. In other words, they're using their credit to borrow money versus convenience. Convenience users basically will buy something on that credit card, and then what they do is they pay it off. Now, one of the things you want to be aware of is teaser rates. A lot of times a credit card will have a teaser rate. In other words, it's a real low rate at the very beginning, maybe for the first few months, and then all of a sudden it jumps up at the end of those months. You have debit cards, all right? A lot of us use our debit cards. It's attached to our checking account, and as soon as we use it, that money comes out of the checking account. And then you have, the gift cards and things like that. Smart cards are out there. Most of the credit cards that are coming out now do have a chip in them that stores data and things like this. Travel and entertainment cards, typically American Express and Diners Club, they don't work that way as much anymore. Most credit cards now are more of the open-ended credit types of things. And then you can also use your smartphone, where you actually attach a credit card to your smartphone. This gives you the various sources of consumer credit that you can check into: banks, finance companies, credit unions, things like this. Now, some of the sources of consumer credit. Okay, you have loans. All right, so you can get all kinds of different types of loans. You can get a loan from your parents. All right, that's pretty cheap. All right, they're not going to charge you much in the way of interest, if anything at all. Medium price loans. Most of the commercial banks, savings and loans, things like that, have medium price loans. It's not as expensive. And then you have what we described in previous chapter, some of the expensive things. Okay, in other words, finance companies, cash advances, things like that. Now you may hear about home equity loans. A home equity loan is where you're getting a loan based on the amount of equity that you have in your home. So for example, let's say that you have a $100,000 home. All right, you still owe $50,000 on your original mortgage. Most lenders will lend up to 75% of the value of the home. So for example, if you have a $100,000 home, 75% of that would be $75,000 that you could take out in a loan. Well, if you already owe $50,000, that gives you a $25,000 borrowing limit that you can get on that home equity loan. A lot of people will use a home equity loan for like finishing a basement or doing some renovation or something along those lines. The thing is, before you take out a loan, can you meet all of your expenses? In other words, your rent, your gasoline bills, your food bills, things like this. One of the things to think about, and these come into some of the ratios that we talked about in one of the earlier chapters, your debt payments to income. One of the things to think about to make sure that you keep your financial life in check is to think about your debt payments to income ratio. Don't let it exceed 20% of your net income. Also think about your debt to equity ratio. How much do you have in liabilities versus your net worth? You need to make sure that it stays below 1. So let's say that Sam has monthly debt payments, including his mortgage, of $825. He clears net income $2,400. Has liabilities of $9,400. His net worth is $24,000. Okay, you can go through and think about what he would be able to borrow and where he is at. Now, one of the things to think about is what's called the 5 C's of credit. Before anybody's going to lend you anything, they're going to think about these things. First of all, your character. Will you repay it? Your capacity. Can you repay it? The capital. All right. How much do you actually have as far as your net worth? Maybe collateral. In other words, you get a car loan. You don't pay it, they're going to take the car back. They're using that as collateral. And then, do you have a secure job? What kind of conditions? So they'll think about the 5 C's before they allow you to take on some of that credit. One of the things that happens is all of our credit is reported to basically 3 companies: Experian, TransUnion, and Equifax. And what they do is they are looking at how are you handling that credit. How much do you owe? Are you paying it back? Are you late? Things like this. There's a lot of information in your credit files. In other words, Social Security number, your date of birth, where you're working, what kind of checks have been returned in SF, okay, insufficient funds. All of this is going into your credit file. One of the things that the federal government passed in 1971 was the Fair Credit Reporting Act, which basically says that anything that's outdated, that's old, has to be deleted. And you do have access to your information, and there are remedies in case something does happen to it. Now, the only people who can get a copy of your credit report are people that you authorize to do that. So you go to a car dealership and you're looking at a particular car, and you're thinking about buying that car. One of the things that they'll do is they'll check your credit, unless you're going to pay cash for it. So they'll check your credit. The way they do that is they give you a sheet of paper that's saying that you allow them to go ahead and check that credit. You have to sign that before they can actually go in and get that information. Now, there are time limits as far as some of the bad information that goes out there. So things that are adverse can still be reported on your credit report for 7 years. Any kind of bankruptcies that you may have had Chapter 7 or Chapter 13 can be reported for 10 years. If you have incorrect information in your file, you can get a copy of your credit report and you can request that information be changed. Now, you do have what's called a credit score. The credit reporting folks will put together a score that goes along with that, and it's called a FICO score. And it goes anywhere from 350 to 850. The higher the score, the better your credit rating. There's also a new one that's come out called the Vantage score. Most people are focusing in on the FICO, though. Now, how do they determine your FICO score? You can see that, first of all, your payment history. Do you pay the stuff back on time is huge. Also, how much do you currently owe? The more you owe, the lower your FICO score will be. It also looks at how long do you have credit history. In other words, have you just started taking on credit cards and loans and things, or have you been around for a while and they have quite a bit of history on that? What kind of credit are you asking for? Is it open-ended credit, or is it like a car loan, closed-ended credit? And then how many times have you been asking for new credit? So all of this goes into your FICO score. Now, the Equal Credit Opportunity Act gives you rights as far as getting credit. In other words, credit providers cannot discriminate against you based upon the various areas where any federal all the federal laws have passed as far as discrimination is concerned: race, color, religion, sex, national origin, things like this. Other things come into it. How old are you? The younger you are, the harder it's going to be to get credit, and the lower your score will be. Are you in public housing? That will lower your score. Things like this. So these are all things to think about when you're thinking about your credit worthiness and getting credit. Now, if you put in an application for credit and you're denied, you do have rights to know the reason. They have to let you know why you were denied that credit. So what can you do to improve your score? Okay, first of all, about once a year or so, get a copy of your credit report and verify the information. Make sure you're paying everything on time. Don't pay late. Learn the legal steps to take to improve your credit report. In other words, what are some things that you can do to make sure that your credit rating goes up? And be aware of some of those credit repair scams. There's a lot of folks out there who will say, okay, well, you pay us this amount of money and we'll make sure that your credit rating goes up. So, are you paying bills on time? What do you have outstanding? How long have you been using credit? All of these things go into your credit score. Now, when you are borrowing money, what's happening is you're paying for it, and there's going to be a finance charge that goes along with it. There may be fees and things like that. There's risk-based pricing that goes into it. One of the things to think about is to really shop around for the credit, because different credit cards, different loans will have different percentage rates. For example, a couple of years ago, I bought a new car. And when I originally was buying the car, I did the financing through the car dealership. I called my insurance agent. That way I got a real good deal. On the thing. I called my insurance agent and said, okay, I'm going to go ahead and insure the car. Here's the new one. And he said, hey, how about putting the loan with us? I got a lower percentage rate going with the insurance company. So what I did was I transferred the loan from the dealership over to the insurance company. Much cheaper. So shop around, folks. One of the things to think about is how long is your loan versus interest costs. For example, if you're going to get a mortgage, you can get a 15-year, you can get a 30-year. 30-year mortgage may lower your interest payment, may lower your overall payment that you pay every month. 15-year loan is going to really reduce the amount of interest that you have to pay. Now, when you think about interest, there's simple interest on declining balance, and add-on interest. And what these will do is determine how much interest you actually have to pay for that loan. So in this situation, Scott's going to borrow $6,000, and he has a choice of those three loans. He could do 6% simple interest, 6% simple interest on declining balance, with annual payments, and then add-on interest. And when you look at what the cost of those are and the amount of interest that you're paying on that, the sum of the payments for the simple interest and then the add-on interest, about $7,080. There's the $6,000 that he borrowed. For the simple interest and the add-on interest, paying $1,000 in just interest over the 3 years. This works out to be a 9% annual percentage rate. The simple declining balance, you pay a heck of a lot less in interest. And it works out to be about the real 6% annual percentage rate. Whenever you're getting a loan, folks, whenever you're going to get a car loan or something like that, make sure that's being done on a simple interest on declining balance. Because a lot of times, some of those car dealerships and things like that will try to do add-on interest. Do it this way. Make sure that your loan is getting it that way. Now, there is a cost to some of the open-ended credit, and it's going to be much higher than closed-ended credit. And one of the things you want to do, make sure you do, is avoid the minimum monthly payment trap. One of the things that credit card companies will do is say, okay, here's how much you owe, and here's the minimum payment to make this month. Many times, people will just do it when they get themselves into a fix. They'll just do the minimum payments. It will take years to pay that off. One of the things that happened as far as one of the more current laws, credit card companies now have to show you how long it will take to pay off the balance on that if all you do is make the minimum payments. And many times it can be many years. If there is a dispute or an error as far as your credit is concerned, you do have recourse. You need to notify the creditor in writing within 60 days. You pay the portion of the bill that's not in dispute. The mistake a lot of people make is they say, okay, I have this one item that I bought, it's not right, I'm not going to pay the entire bill. No, you have to pay everything but that portion that's in dispute. Credit card company has 2 billing periods, but no longer than 90 days to correct it and tell you why they think the bill is correct or fixing it. All right? Disputing an item does not impact your credit rating. All right, so these are some things to think about if there is an error or there is a dispute. For example, I purchased something off of Amazon. I put it on a credit card. It never came in. And I disputed that item through Amazon and through my credit card company. Eventually, they worked it out where it was taken off of my bill because it never did come in. One of the things you want to do is make sure that you're protecting your credit rating. All right. People cannot threaten to damage your credit reputation while you are negotiating that dispute. If you get something that's defective, then you have to make a sincere effort to resolve it. All right. Not just, okay, it's not working right, and then start filing suits and things like that. You have to actually work with the folks to try to get that sucker resolved. If you have your identity stolen, one of the first things you want to do is contact the major credit bureaus, also the credit card companies and things like that. Make sure you also file a police report. That is going to help protect you as far as your identity is concerned. Another way to think about was shredding any kind of papers that contain personal information. Remember, we talked in Chapter 1 about the types of things you want to keep. Anything that you don't keep, make sure you're shredding it. And you can pick up a shredder for less than $50 at like an Office Depot or something like that. One of the things that has happened a lot of times is machines, like you go to fill up your gas tank and you put your card in the card reader. There may be a thing in there that will read it, and they can steal your credit card company. It's called credit card number and your information. It's called skimming. If you think that something has happened to one of your accounts, close it immediately. All right? And so you need to make sure that you are protecting your credit as much as possible from theft. Use a secure browser when you are browsing online. So for example, I use primarily Chrome, Google Chrome, or I'll use Firefox. They are much more secure than Internet Explorer. So I will always use those. I stay away from Explorer. Make sure you keep records of all your online transactions and the things that you've done so that you're not surprised about some things. Always review your bank and credit card statements. See what might be out there that you don't recognize. I had a situation one time where there were things that were showing up, and it was showing up every month on the credit card statement. I thought my wife was buying something, and I saw it the second month and it was the same amount as the month before, and then the third month it was the same amount as before. And so I asked my wife about it. She said, "No, I'm not buying anything from them." Contacted the credit card company. Turned out that it was a scam that was going on, that somebody had gotten it, and this company just kept charging my card. I was able to get my money back too. Okay. Thank you, American Express. One of the things to think about is co-signing loans. Now, when you co-sign a loan, what you're doing is you're guaranteeing that the person that you're co-signing it for will pay it off. Many times, parents will co-sign a loan for their kids to buy a car or something for the first time. That's cool. I don't have a problem with that, as long as the parents know they are going to be responsible for paying it off if the kid doesn't. One of the things to think about is, do not ever co-sign a loan for one of your friends or something along those lines, because you will be on the hook for paying for it if they don't. If you do have a complaint, resolve it directly with the creditor. If that fails, then go through the various credit protection laws that will help you with that. These are some of the laws. Just be familiar with them. They're in the text. One of the things to think about is warning signs as far as your debt problems. Are you paying only the minimum balance every month? All right? Or are you even having trouble paying the minimum balance? You find your balance is increasing every month. That's going to tell you that you have a problem there. If you're paying late or you're missing loan payments, using savings to pay for necessities. All right? These are all telling you that you have a problem. You're going to have to do something about that. The Federal Trade Commission has the Federal Debt Collection Practices Act, where if you are placed for collection, there are certain things that collectors can do and they cannot do as far as trying to retrieve that. If you find that you are in trouble as far as your finances are concerned, there's always Consumer Credit Counseling Services. All right, they are reputable. They're a nonprofit, and what they will do is help you work through any kind of savings plan or a spending plan, to put together a plan so that you can get out of the credit problem that you've found yourself into. There may be other things that could help you out, like universities or extension agents or something like that. Maybe talk with your bank or somebody else that might be able to help you with that. Last resort is bankruptcy. All right, that's going to kill your credit as far as anything is concerned. There's Chapter 7 and Chapter 13. Chapter 7 is basically liquidation. I'm just done. All right, I'm just going to, I want to give up. Chapter 13 is a plan that you work out where you pay off all of this stuff. When you think about what's worse, Chapter 7 is worse. Chapter 13 is basically saying, okay, I will help work through this. I'm going to pay everything off. All right. Do everything you can to try to avoid bankruptcy if you can, because it really does impact your credit for the long term. You can see that there have been quite a few bankruptcy filings over the years, and you can see where the bankruptcies actually peak based on downturns in the economy. Now, there have been some laws passed recently that kind of stops you or holds you more accountable for some of the bankruptcies and things. If you do choose a Chapter 7 bankruptcy, most but not all of your debts will be forgiven. Assets are sold off, all right, things like this. In other words, you've basically given up. Here, take everything. Now, depending upon the state, they might take your car, they might take your house. Depends. Chapter 13 is a repayment plan, all right, and it's become much more difficult to file a Chapter 7 bankruptcy, where they're trying to say, you know what, you've gotten yourself in this, you're going to have to get yourself out. And so they really would prefer to set up something where you do have some sort of a repayment plan. could last up to 5 years, all right, and it's basically court appointed court-appointed trustee who will take the information and distribute will take the dollars and distribute it amongst the various people that you owe money to. When you do declare bankruptcy, trying to get credit down the road will be difficult. However, a lot of companies will go ahead and extend credit to you at a very high cost, though. But they'll extend it because they know that you can't file for bankruptcy for 8 years. So, as far as a summary is concerned, be aware of the differences between open and closed credit. Be aware of some of the uses and some of the advantages and disadvantages of credit. Think about how credit is actually being measured and your capacity to do that. Think about the 5 C's: character, capacity, capital, collateral, and conditions. Shop around. Make sure you're getting the best deal that you can. If there is an error, you do have recourse, and you need to make sure that you're doing everything you can to protect your credit rating. You do have various laws that can help you. If you can't meet your obligations, contact folks immediately. Get some help through the Consumer Credit Counseling Services. Last resort is bankruptcy. If you have questions, give me a shout.